Hey traders, this is Blake Morrow with Traders Summit. And with me today, for the very first time, I have Mr. Jamie McGeever. He is a columnist at Reuters. It's really nice to have you here, Jamie.
Nice to be here, Blake. Thank you for having me.
Oh, it's my pleasure. I've been following your work for years. We've talked in the past. We run along the same schedule, let's call it, as far as timeline goes. But you've been around the block for many years and reporting on the markets. So I'm really excited about interviewing you right now because I think your insights are going to be invaluable to the trading community.
Well, thank you very much. Very kind of you to say, very nice words. And yes, I have been around the block a bit. I think, what are we in 2023? This is my 25th year of covering markets in one guise or another. So yes.
It's interesting because this is my 25th year of actually starting on a trade desk. So, it's interesting because we've seen a lot of the same things. And I could say probably on both of our behalves, we've seen a lot of stuff that you thought you'd never see before.
That's just in the last couple of years.
Yeah, right. That's not including everything in '99 and 2008 and holy cow. But anyway, that's neither here nor there. But what I wanted to talk with you today is, based on your experience and what you cover, since you're a markets reporter, today's CPI was rather important because it's really going to set expectations for what the Fed and for all intents and purposes for what other central banks might be doing, generally speaking, in the months ahead and maybe even the year ahead. So let me ask you this: we just had CPI release, came in a little bit below consensus expectations. How are you processing it, and how do you think the market's going to process it, based on your opinion, of course?
My opinion, of course. Well, as a Reuters reporter as such, I have no official opinion, but I certainly have. I can tell you what I'm seeing based on market reaction and in the numbers themselves. As you say, it was just below consensus. I think core was in line with consensus, and even the headline CPI was just below 3.2 versus 3.3 forecast. I mean, if you take a big stand back view from that, it's much of a muchness, and you could say it's in line. However, I think the way the wind is blowing on this one, I think it's a dovish wind is blowing, and I think we can see that from the market reaction. Just before we got on the call, I had a quick look at the futures, Fed funds futures and software contracts, and the CME FedWatch tool. And as far as I can see, the rate hike for next month, for September, has been taken out of that part of the curve. No more rate hikes priced in for the rest, or no more rate hikes fully priced in for the rest of the year even. So that basically tells you that the market now thinks that the Fed's done. And as we've seen over the last few weeks, a fairly substantial amount of easing priced into the curve next year. I think that tells you all you need to know about the way the market's interpreting this. And I think, the market has been sort of fighting the Fed, if you like, for about a year plus, as we've discussed before. And the Fed's been right, obviously, up until now. But I think the market may be getting this one just about right. If you look at the details of the CPI report, if you strip out housing costs, owner's equivalent rent and various other related measures of housing costs, you strip out the housing costs, and inflation's got a two-handle, if you look at it that way, and core inflation has a two-handle. It's about two. I think I've seen some of the analysis from economists in the last half an hour or so. 2.5% core inflation. If you strip out housing costs. Now, again, if you strip out all the things that we pay for, inflation is pretty low. I get that argument too.
Right. We can tweak it just however we want it, right?
You can massage it however you want. But housing costs, I think, are varying between 7 and 8%. A year inflation rate, and that's obviously very high. But that is what is accounting for, again, going by various cuts of the measure of the data. That's accounting for half, if not 80-90% of all of the 3.2% rise in inflation. So it's been very sticky over the last few months. It's not come down below 7% for at least a year. If that starts to gradually ebb lower, I think we'll see CPI inflation, headline and core, come down too. And I think, again, if you just that one sector of the economy is keeping inflation pretty high. It depends how much stock you put on that, how fast you think, or otherwise you think that's going to come down. But that's what's keeping inflation above target.
Yeah, that makes sense, and it is housing is a bit of a tricky. How should I say it? It's been more of a, I don't know if it's a problem that the Fed created itself, but it's definitely an issue for most Americans. I've heard affordability is, it's just really not there. I just read a statistic about 75% of the average American can't afford housing right now, and it's a shame, but it also does factor into, the CPI. Now, with that being said, I wanted to ask you a question based on your experience and what you've seen over the years, over your 25 years of market coverage experience. Back in the day, you could go back to the Alan Greenspan years, back earlier in your career, in our career. The markets used to be surprised by central banks. It's really not the case right now. And as you mentioned just a moment ago, futures are not pricing any more rate hikes into this year. Now, obviously, data can come in. We're going to have a lot of data inputs between now and the next Fed meeting in September. But let's just say, based on your experience and what you know about the Fed and what you've seen action-wise from not only the Federal Reserve, but it seems like a lot of central banks, surprises don't seem normal. I mean, if the market is pricing in, there's prices in that there's no cuts coming, or excuse me, no more hikes coming. So there's probably a pretty high probability this Federal Reserve, at least Powell's Federal Reserve, is not going to hike rates. Or would you say otherwise?
Yes. I mean, I think broadly what you say is correct. However, you mentioned Alan Greenspan, and going back to Greenspan, as you say, maybe back in the 90s, there was more leeway for surprises, whether it be from central bankers themselves or from the data or from markets. There was a bit more volatility. And however, Greenspan was the first one, or he was the master perhaps of giving forward guidance. I mean, if you recall I think it was in the 2000s, when the Fed was hiking rates by 25 basis points every meeting, it was, I think the phrase he used was measured pace. We're going to raise rates at a measured pace. And that forward guidance and that steady rise in interest rates, it made central banking and monitoring the Fed pretty boring for a while. Now, there was the general macro environment was maybe less volatile then, but central bankers made it their aim to make central banking boring, more predictable, more transparent, communications improved, etc. Back then, of course, you had the great financial crisis, and that kind of blew everything out of the water, and they had the pandemic. So everything's back up in the air again. I think the Fed would like to make central banking, and others would like to make central banking more boring again. However, on the surprise element, as we just touched on earlier, the Fed's been making it pretty clear over the last year that they're going to, be raising rates aggressively, keep them high for longer if need be, and that policy will be tighter, certainly than the market has been pricing in for about a year, 18 months. The market has basically got this wrong. And so the Fed's been trying to tell the market where it's going and why it's doing it. The market refused to believe it, and they're kind of paying the price in a way. Whether the surprise is likely to come from now, well, now that we've come up to the top of the hill, maybe the Fed does it walk the market back down the hill, or does the market walk the Fed back down the hill?
Yeah.
Or does the data move both back down the hill? And that remains to be seen. But with about 125 basis points of easing priced in for next year, I suppose on just the balance of risk or skew or positioning, the surprise element would be that the Fed does stay higher for longer, and that there's not that extent of policy easing in the curve next year.
Yeah, and that's where I know we briefly spoke just ahead of this recording that Jackson Hole's coming up here in the next couple of weeks at the end of the month, and that's where a lot of people will be taking cues from not only, you know, the Fed chair, but also other regional governors and central bankers from around the globe to kind of it's like that interim semi-quasi Fed meeting, not really a Fed meeting, but you know, a lot of times policy cues can be taken from the Jackson Hole Symposium every year. So I think that's going to be closely watched. You know,
Indeed.
Jamie,
Yeah, almost certainly, yeah. And I think, sorry to interrupt, but I think the topic, I just noted this down, the topic for this year's symposium is structural shifts in the global economy. That's the
theme.
That's the theme. Now,
so how would you translate?
That's all encompassing. I mean, that's a pretty broad tent.
That is. So, you know, I think there's going to be a lot of takeaways from Jackson Hole this year, especially that we are at such a tipping point. And you know, again, I know you can't really give your opinions here, but if gun to your head, do you think Fed or central bankers are going to continue to fight inflation, or maybe I'll ask it a different way. You know, if you look at central bankers and what they're fighting an inflation battle, which it looks like as of right now, all the data is coming in disinflationary. They're kind of winning that battle right now. But if we started to see the global economy sputter and we'd see, you know, the jobs market start to show some softness, not only here in the US, but globally, what fight do you think central banks would take? They would fight inflation, or they'd be more keen to fighting, you know, growth and the economy? What are your thoughts? And again, I know it's an opinion. Just
no, that's that. I mean, I think to use the analogy, I'm not sure it's a very good one, but you know, we're up at the top of the hill now. The Fed and everyone's taking everyone up to the top of the hill. Now we're at that inflection point where, you know, we've seen in the CPI data, US inflation is clearly slowing. Again, by some measures, it's back to pre-pandemic levels. Again, if you strip out bits and pieces. And the trend's pretty clear on a 2-month, 3-month, 6-month rolling basis. Inflation is clearly coming back towards Fed target area. However, as you know, as a smart person once said, the last mile is the hardest. And so to get from 10 or from 9 down to 3, 4, okay, we can do that. But to get from 3, 4 down to 2, that's the hard bit. Now, maybe this year's topic at Jackson Hole, structural shifts in the global economy, does that? I mean, that can mean one of a million things. But the debate has certainly increased in the last year or so about central bank targeting, inflation targeting. Does everybody stick with this 2%, which has been around for about 20, 30 years, or do they start to think about maybe 3%, 3 or 4%? So they've got to think about the trade-offs that might entail, the political effort and capital that will have to be spent to try and make that happen, the communications with the public, all that kind of stuff. We may be in that territory if inflation sort of doesn't come down towards that too. However, as you say, if the global economy starts to really slow and unemployment here starts to pick up, that might do the Fed's work for it. However, they won't be keen to see recession, or they'll be keen to mitigate the impact of a potential recession. All that to say, it's a roundabout way of saying, they could go one of either way. However, I think the inflation fighting credibility, the Fed and others have certainly put that as number one priority, well, since the pandemic. And that's been, I think that's safe to say. Do they want to kind of flip pretty quickly? Do they want to maybe put that in jeopardy and go back to the sort of Fed put kind of mindset? Unlikely. I think it's maybe in days gone by, we might have said, yes, that's what they'll do. I think Powell and co they've held the line pretty well so far. Again, it depends on the pace of economic slowdown or the degree of recession, or if there's any other shock, maybe another banking shock or something, then they will respond, of course. But I think they'll be keen to hold the line as long as they can.
Jamie, I agree with you, and I think central bankers are scared for, a repeat of the misses in the late 70s, early 80s, where, you and I were just young lads and not paying attention to central bank policy at that point, or inflation for all we mattered at those ages. But it's going to be interesting, and I think that's something that I'm going to be reading your columns there on Reuters, as I always do, and I try to catch as many as possible, because I think your coverage is always the best. It's you pointed out that the theme this year at Jackson Hole is structural shifts in the global economy, but maybe it'll be structural shifts in global central banking might be the actual theme behind this year.
Well, if that's the case, then I think Powell's and the Fed's BOJ counterparts can take centre stage, because as we both cut our teeth in the 90s, since then the Bank of Japan has been at the vanguard of sort of central banking, global policy making, and where they've led, others have tended to follow, whether they wanted to or not. Of course, the Bank of Japan is a very important one now. They're moving away from their yield curve control, and have just laid a surprise to the markets in the last couple of weeks. I would watch what Ueda says at Jackson Hole, presuming he's going. And then just before we spoke, actually, I see the yen. It's fascinating. Although the Bank of Japan is certainly moving in a more hawkish direction, we've seen the yen fall to its lowest against the euro since 2008, and dollar yen's now in kind of that 145 area where the BOJ was intervening. Was it last year, September, October last year? So we're getting into that territory where maybe the market is pushing against the Bank of Japan, and it's now over to you, BOJ, to see if they react.
Yeah, right now, as traders, we are waiting for the checking rates headlines to hit the wires from the Ministry of Finance, and when that happens, we start going, starting to buy in yen. But yeah, the yen can't get
back
out.
In the day, the Bank of Japan was checking rates to sell yen.
Yeah, so much different.
Checking rates to buy yen.
In that wild. So let me ask you this before we go, and I really appreciate your time, but the Bank of Japan was probably really boring to cover for you for so many decades. Yeah. How about now? I mean, it's on your radar, right?
It certainly is. Yeah. I mean, the bank. I mean, well, even the Bank of Japan policy rate is still minus 0.1%, I think.
Right.
That's not going to change, even if the yield curve control and the sort of bond market and the interest rate, the sort of QE side changes. I don't think the policy rate is going to change well until next year. Some banks think it's going to be perhaps into 2025. So, what the Bank of Japan does with the bond market is fascinating, and that will have a huge spillover effect into the global economy, just because of the sheer size and footprint that Japan has in capital markets, not least here in the States, in the US bond market. Japan's holdings of US Treasuries, government holdings are obviously huge. We all know that. Over $1 trillion of Treasuries holdings. And Japan, Mr. and Mrs. Watanabe, Japan's retail investment community, they have trillions of dollars worth of overseas investments as well. So if the policy rate, or if yields in Japan do rise, once you take into account FX hedging costs, it may be more attractive for those domestic investors and savers in Japan to just bring their money back home, and that repatriation flow could be potentially huge, and that will have a huge spillover effect into the FX rates, into the dollar, and into potentially US Treasury yields.
Treasuries and yields, yeah, absolutely. Well, that's something that I know as traders, we are going to all be looking towards, not necessarily towards, but for, I guess, in the coming months and probably the second half of this year and into 2024. Second half of this year. I'm already figured out we're past that. Already the second half.
Point. Yeah.
I know. Hey, Jamie, I want to say, it's been really great to have you here. I'd love to have you back on here on the Trader Summit at some point. And because I think your knowledge is invaluable. You've been covering the markets, like you said, for a quarter century now. And
that sounds longer than 25 years.
What's that?
quarter century sounds longer than 25 years.
Yeah, 25 years or 2 plus 2 times. Yeah, let's do it that way. But yeah, you've been covering markets for a long time. And like I said, the knowledge that you have is invaluable. Love having you here. And we really appreciate your time. What's the best way for traders to follow your work like I do?
As you said at the top of the show, Reuters.com, my columns and stuff, my articles are on Reuters.com, and I'm on Twitter as well, although I don't think it's called that anymore, but at Reuters Jamie, all one word, at Reuters Jamie.
And you're a wonderful follow, by the way. So thank you so much for playing such a big part in the financial markets, in traders' lives like mine. And thanks for spending your time here with us. And make sure you follow Jamie. Give him a big thumbs up down below, and subscribe to this channel so you don't miss any of our exclusive content here at Trader Summit. Jamie, thanks so much. Have a great day today.
You too, Blake. Thank you. All the best, and look forward to speaking with you again. Bye-bye.
Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.